If you own an incorporated business and you're transferring money from the corporation to yourself whenever you need it, stop. That money isn't automatically your personal money just because you own the company. And how you pay yourself matters. Salary, dividends, a combination of both. The wrong approach can create tax problems, cash flow surprises, or missed planning opportunities. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. One of the most common questions incorporated business owners ask me is, Everald, should I pay myself a salary or dividends? And my answer is, it depends. Because the best choice isn't simply about which option appears to produce the lowest tax bill today. It's about understanding your complete financial picture. First, understand the difference. Let's keep this simple. When your corporation pays you a salary, that salary is generally an expense to the corporation, provided the usual tax requirements are met. For you personally, it's employment income. Salary generally creates RRSP contribution room and normally involves CPP contributions. The corporation also has payroll responsibilities, including withholding and remitting applicable amounts to the CRA. Now consider dividends. Dividends are generally paid from corporate profits after corporate income tax. They aren't treated as a salary expense of the corporation. Eligible or non-eligible dividend rules may apply depending on the corporation's circumstances. Dividends generally don't create RSP contribution room and ordinarily don't attract CPP contributions. So already, salary and dividends can affect much more than your personal tax return. Imagine two incorporated business owners. Both need $100,000 personally during the year. The first owner says, just pay me dividends. I don't want payroll. The second says, just pay me salary. That's what I've always done. But neither has asked the bigger questions. Do they want to build RRSP room? How important are CPP contributions to their retirement planning? Does the corporation have sufficient cash? What type of corporate income is being earned? Are there other sources of personal income? Does the owner need predictable income for a mortgage application? Are there family or retirement considerations? Suddenly, the question isn't which one pays less tax. It's which compensation strategy makes the most sense for me. And here's the mistake I really want you to avoid. Your corporation is a separate legal entity. Its bank account should not be treated like your personal wallet. If you continually withdraw corporate funds without properly determining whether those amounts are salary, dividends, reimbursements, repayments, or shareholder advances, you can create messy accounting records and potentially serious tax consequences. For example, certain amounts owing by a shareholder to the corporation can be subject to specific shareholder loan rules under Canada's Income Tax Act. That's why owner withdrawals need to be properly recorded and reviewed. Don't ask only how you should take money out of your corporation, ask what you're trying to accomplish with that money. Taxes matter, but so do retirement planning, cash flow, borrowing capacity, CPP, RRSP room, and your long-term financial goals. At Melbourne Accounting Solutions, this is exactly the kind of conversation we believe incorporated business owners should be having before year-end, not after. We can review your corporate income, personal cash requirements, tax position, compensation history, and longer-term objectives before recommending an approach appropriate to your circumstances. Because there isn't one salary versus dividend answer that's right for every business owner. There should be a strategy behind the answer. If you've been taking money from your corporation without a clear compensation strategy, let's have that conversation. We can help you understand your options and make a more informed decision. Before your next withdrawal from your corporation, ask yourself, do I know exactly how this payment will be recorded and why I'm taking it this way? If the answer is no, that's a conversation worth having before the money leaves the company. I'm Us Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future Canadian business, tax, accounting, and financial insights designed to help you succeed. And if your corporation doesn't currently have an owner compensation strategy, contact Melbourne Accounting Solutions. Let's review your situation and determine what makes sense for you. Helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.